Imagine you're planting a garden. You wouldn't throw all your seeds in one spot, right? You'd spread them out, giving each one space to grow. Investing is similar. It's about planting seeds for your future financial well-being. Just like a garden needs different types of plants, your investment portfolio should include a mix of assets. This diversification helps weather market storms and ensures a bountiful harvest in the long run. Investing is not just for the wealthy. It's for anyone who dreams of a secure future, whether it's a comfortable retirement, a dream vacation, or financial freedom. It's about putting your money to work, allowing it to grow and compound over time. Think of it as planting a money tree. The sooner you plant, the more time it has to flourish. But where do you start? The world of investing can seem daunting, filled with jargon and complex strategies. Don't worry, we'll break it down into simple terms. We'll explore 3 key investment types: index funds, stocks, and bonds. Each has its own characteristics, risks, and rewards. Understanding these basics will empower you to make informed decisions and build a portfolio that aligns with your goals. This guide is your roadmap to navigating the investment landscape. We'll equip you with the knowledge and confidence to take those first steps, turning your financial aspirations into reality. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Let's start planting. Imagine trying to pick the winning numbers in a lottery. It's nearly impossible, right? Picking individual stocks can feel similar. It's difficult to predict which companies will outperform the market. That's where index funds come in. They're like buying a ticket that represents all the numbers in the lottery. You're not betting on individual companies, but on the overall performance of the market. An index fund is a type of mutual fund that tracks a specific market index, such as the S&P 500. This index represents the performance of 500 of the largest U.S. companies. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of each of those 500 companies. This diversification spreads your risk and increases your chances of riding the market's upward trend. Index funds are a great choice for beginners for several reasons. Firstly, they're incredibly simple to understand. You don't need to be a financial expert to grasp the concept. Secondly, they're very low cost. Since they passively track an index, they don't require expensive active management. This means more of your money goes towards actual investment, not fees. Finally, index funds have a proven track record of delivering solid returns over the long term. While they may not experience the explosive growth of individual stocks, they offer a more stable and predictable path to wealth accumulation. Think of them as the tortoise in the investment race, slow and steady, but ultimately winning the race. Imagine owning a piece of your favorite company, a company that makes products you love and use every day. That's what stock ownership is all about. When you buy a stock, you're buying a small piece of ownership in a company. You become a shareholder, entitled to a portion of the company's profits and voting rights on certain company decisions. Stocks offer the potential for higher returns than index funds. When a company performs well, its stock price generally goes up, increasing the value of your investment. You can also earn dividends, which are payments made by the company to its shareholders, typically from its profits. Think of it as receiving a share of the company's success. However, stocks also come with higher risks. The value of a stock can fluctuate significantly based on various factors, such as company performance, industry trends, and overall market conditions. If a company faces challenges, its stock price may decline, resulting in a loss for you. It's important to remember that stock investing is a long-term game. For beginners, it's crucial to approach stock investing with caution and a focus on learning. Start by researching companies you understand and believe in. Look for companies with a strong track record, solid financials, and a competitive edge in their industry. Remember, investing in individual stocks requires more research and monitoring than index funds. Imagine lending money to a friend or family member. You expect them to repay the loan with interest, right? Bonds work in a similar way. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to repay the principal amount at a specific maturity date, along with periodic interest payments. Bonds are generally considered less risky than stocks. They offer a fixed rate of return, providing a predictable stream of income. Governments and corporations are typically obligated to repay their bondholders, even if they experience financial difficulties. This makes bonds a relatively safe investment, especially for those seeking stability and income. However, bonds also come with their own set of risks. Inflation can erode the purchasing power of bond interest payments over time. Interest rate changes can also impact bond prices. If interest rates rise, the value of existing bonds generally falls, as investors can find higher returns elsewhere. For beginners, bonds can provide a stabilizing force within an investment portfolio. They can help reduce overall portfolio volatility and provide a steady stream of income. Consider incorporating bonds, especially government bonds, to diversify your investments and mitigate risk. Section 5. Diversification. Don't put all your eggs in one basket. Imagine putting all your savings into a single stock. What happens if that company fails? You lose everything. That's why diversification is crucial. It's like the old adage, don't put all your eggs in one basket. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate. By diversifying, you reduce the impact of any single investment on your overall portfolio. If one investment performs poorly, others can cushion the blow. It's like having multiple streams of income. If one dries up, others can keep you afloat. Diversification helps mitigate risk and increase the potential for long-term growth. Think of your investment portfolio as a team of athletes. Each athlete has their strengths and weaknesses. Some are fast, others are strong, and some are agile. By combining different athletes with complementary skills, you create a well-rounded team that can handle any challenge. Similarly, by diversifying your investments, you create a resilient portfolio that can withstand market fluctuations and achieve your financial goals. Remember, diversification is not about eliminating risk altogether, but about managing it effectively. Section 6. Risk versus reward. Balancing act for smart investing. Imagine a seesaw. On one side is risk and on the other is reward. The higher you go on the risk side, the higher you can potentially go on the reward side. But the reverse is also true. The higher the risk, the greater the potential for loss. Understanding this relationship is fundamental to smart investing. Stocks, for example, offer the potential for higher returns than bonds, but they also carry higher risk. Bonds, on the other hand, provide a more stable and predictable return, but they may not keep pace with inflation. It's a balancing act. You need to find the right mix of risk and reward that aligns with your investment goals and risk tolerance. Your risk tolerance is your ability to handle potential investment losses. Some investors are comfortable with high risk, while others prefer a more conservative approach. Factors such as your age, financial situation, and investment goals can influence your risk tolerance. Remember, there's no one-size-fits-all approach to investing. What's right for one person may not be right for another. It's crucial to assess your own risk tolerance and choose investments that align with your comfort level. If you're unsure, consult with a financial advisor who can help you develop a personalized investment strategy. Section 7. Starting your investment journey. Small steps, big dreams. Imagine climbing a mountain. It seems daunting from the bottom, but every step takes you closer to the summit. Investing is similar. It's a journey, not a sprint. Start with small, manageable steps and gradually increase your investment as you gain experience and confidence. The first step is to set clear financial goals. What are you saving for? Retirement? A down payment on a house? A dream vacation? Once you know your goals, you can determine how much you need to invest and what type of investments are suitable. Next, create a budget and identify areas where you can save money. Even small amounts can make a difference over time. Consider setting up automatic transfers from your checking account to your investment account. This ensures regular contributions and helps you build a consistent investing habit. Remember, you don't need a lot of money to start investing. Many investment platforms allow you to start with as little as $100. The key is to start early and remain consistent. Time is your greatest asset in investing. The sooner you start, the more time your money has to grow and compound. Section 8. Patience. The secret ingredient to investment success. Imagine a farmer planting seeds. They don't expect to harvest crops the next day. They understand that growth takes time, patience, and nurturing. Investing is no different. It's a long-term game, and patience is the secret ingredient to success. The stock market can be volatile in the short term. Prices can fluctuate wildly, driven by news, emotions, and speculation. But over the long term, the market tends to trend upwards, reflecting the overall growth of the economy. Patience allows you to ride out these short-term fluctuations and benefit from the long-term upward trend. Think of investing as planting a tree. You wouldn't dig it up every few days to see if it's growing. You give it time, water, and sunlight, trusting that it will eventually bear fruit. Similarly, with investing, you need to trust the process, stay disciplined, and avoid making impulsive decisions based on short-term market movements. Patience is not about inaction. It's about staying focused on your long-term goals, making informed decisions, and resisting the urge to react to every market blip. Remember, time is your ally in investing. The longer you stay invested, the greater the potential for your wealth to grow. Your financial future starts today. Just like planting a garden, investing is about nurturing your financial future. It's about making informed decisions, diversifying your portfolio, and staying patient. Index funds, stocks, and bonds each play a vital role in building a resilient and rewarding investment strategy. Remember, investing is not just for the wealthy. It's for anyone who dreams of financial security, freedom, and a brighter future. Start small, stay consistent, and let time work its magic. Your financial future starts today. Take the first step. Educate yourself, explore your options, and seek guidance if needed. Remember, the best time to plant a tree was 20 years ago. The second best time is today.